Welcome. Good morning. You're watching India Market Open. It's Tuesday, the 17th of September, and the much anticipated Fed meeting kicks off later tonight on Wall Street. So lots to track, lots to watch. We've been talking about this for months together now, and that event will be around the corner soon.
Yeah, world markets all over waiting for the Fed to move and then trying to think what could happen to the EM pack, currencies, rates, what all. I mean, the two most important days, frankly, in the calendar.
Imagine being Jerome Powell this morning with the weight
Such
of
fun.
the world on your shoulders as well. But yeah, that of course is the big event, the anticipation, and we aim to get you all the information you need to on how to trade that event. But before we get to that, thank you to all our viewers and congratulations, guys. The NDTV Profit YouTube channel has hit 1 million subscribers.
Yeah, just shows that one, we are doing something right everywhere else and on YouTube, and the fact that people are liking it because the subscription numbers have been tremendous. Our ratings during all the key days on YouTube have been fabulous. So, yep, vindication of something.
So thank you guys. More than anything else, thank you so much. And please, if you haven't subscribed yet, you know what you have to do. If you haven't told your friends and family to do that as well, please go ahead and do that. Now, having said that, let's kick off with the global cues this morning. Mixed kind of day of trade for US markets at least. In terms of tech stocks taking a beating more than anything else. So ahead of the FOMC meet, a bit of, I would say, cautious mode on Wall Street. Dow was up about 200 points, but it was the Nasdaq that was hit, in part because of Apple. Apple stocks also slid because apparently the appetite for the iPhone 16 is not as much as what was expected. So a little bit of a downer there, and you had the Nasdaq 100 slide. But they're not done yet with all the data because retail sales data for August comes in later tonight, even as the FOMC meet kicks off. It could be something that the Fed takes into consideration when they're deciding. You know, the street assumes between 25 basis points and a 50 basis points cut over that two-day meet. So that data that comes out today also becomes important. Bond yields have slid a bit ahead in anticipation of those rate cuts, the 10-year at 3.62%. Crude has actually jumped up despite slowdown concerns in China. There's a hurricane out there, Hurricane Francine, which has disrupted supply in the Gulf of Mexico. So you had Brent nearly back at $73 levels or close to $73 levels. So quite a jump up there. Gold shining bright in anticipation of that cut. 2610 on gold was the rate that at least I saw last. So record levels continue there. And Asia has opened decently, but is again a bit mixed ahead of the Fed rate. We'll quickly pull up the implied open before we get to our global conversation this morning. And you're looking like you're in at least for a positive start. No runaway gains. I suppose caution continues to be the name of the game. And to speak more on that, Rana Gupta joins us now. He's Senior Portfolio Manager of India and Equity Specialist at Manulife Investment Management. Mr. Gupta, great to have you on the show. Very good morning from where we are.
Good morning.
Right now, yeah, and let's just start about the question of caution. And, you know, my primary question is that what is the concern? What is the biggest negative that could come out of this two-day meet, considering that at 25 basis points is pretty much priced in?
Sure, I think just on the rate cut, whether it is 25 and 50, I think that will definitely cause some short-term volatility in the markets, depending on expectations, so many other things. But the broad takeaway is this, that the US Fed is now embarking on rate cut cycle. They have themselves said that the rate cut, the extent and the pace will be data dependent. So I think it is not so useful for us who are medium to long-term investors to predict meeting by meeting cut. But broadly, we can take a step back and say that if the inflation is stabilizing at around 3%, even at 50 bps real rate, the rates can go down, let's say, 150 to 200 basis points over a period of time, not immediately. The fact that the Fed is there and they are willing to do whatever, the rate cuts when the data comes in, gives a sense of comfort to us. Having said that, there are risks that you asked. There are risks. Short-term risks are what market prices in vis-a-vis what Fed delivers. That's a short-term risk. In the medium-term risk is that Fed is obviously cutting rate because they see some slowdown in the real economy. Now, whether Fed will cut quickly to take care of the slowdown, that remains the risk. Our view is that Fed is definitely watching the economy and they have to do what it takes. But I think the risk could emanate from that Fed not acting soon enough.
Right. Hi, Rana. It's also Samina joining in. The last couple of months to the run-up to the Fed have seen emerging markets see record inflows. A lot of that money is going into debt, from what we understand. Do you feel that the next couple of months or the next 2 to 3 quarters, it could be debt that outshines equity for emerging markets like India?
I think there are 2 or 3 things. I think particularly if you ask an Indian context, Indian macros in terms of fiscal deficit, current account deficit, inflation, foreign reserve, all these if you map over last 10, 15, 20 years, it has never been this good. So the way to play macro improvement is through debt markets. On the top of that, you have this, bond inclusion, so you get naturally some buying through passive funds and so on and so forth. So I think the debt remains in a pretty good.
Lost the audio.
In a real being where it is, you still get a pretty decent real return. So I think debt from that perspective looks good. But I do think that the broader message here is falling cost of capital, and that in turn is good for equities also.
Okay. Remember, the Fed meet, as everybody now knows, begins today, but the market is pricing in a 62% possibility of a 50 basis points rate cut as per the CME Group's Fed Watch tool. Now, this has moved up from a probability of 25% a month back. Rana, if indeed it is not 50, but it's 25, and the Fed trades on the side of caution, is that a spoiler for risk assets?
In the very near term, it could be, but I think more important for, let's say, medium term is going to be what Fed is going to say in terms of their outlook, how prepared they are to cut, what are their views on the labor markets, whether it's going to be completely data dependent or not, what the committee members think in terms of rates, let's say 6-12 months down the line. So I think Fed rate cut itself is an important event, but the guidance, the press conference happens to that. It's basically, it's also equally important if you have a 3 to 6 months view in the market.
Very lastly, Rana, I'm not sure if you track India specifically, and just moving away from the Fed for a minute. Indian equity markets seem to dance to their own tune in that sense. We've held out quite well. Domestic inflows are very stable for our markets. As an outsider, are you attractive to Indian equity markets, or do you feel like the value here is missing and the risk reward remains favorable for developed markets like the US?
No, so we are pretty much into the Indian equities. So I think the question on valuation, I think it's a pretty broad topic, but nonetheless, I'll just highlight a few things. First of all, we don't think for the large cap stocks, the valuations are way too expensive, right? Probably the market is showing 10-15% premium to the longer term averages. And in our view, that can be justified given the macro improvement has happened in the economy and the corporate earnings that has grown. But there are in certain pockets there are views that the market's overvalued and it could correct. I'll just put forward what we think in addition to what I just said. See, first of all, domestic flows, as you pointed out, have remained strong. Domestic flows are going to get to about $100 billion plus this year, as opposed to the new equity supply being lower than that. So when there is more demand of equities than supply, the prices are going to go up a bit. So that's the first thing. And then delve a little deeper. Why the supply of equities are lower? Because the corporates, they are protecting their balance sheet, their profits are improving, their cash flows are improving, their ROE is improving, which makes the stocks attractive asset to begin with. And then they are adding capacity only at a very moderate pace, which means the profits can go to sustain for duration for longer period of time. Also, because the supply of the corporate paper for growth capital is limited, at a time when the demand for equities is strong, the valuation is where it is. I think this demand supply equation for equities is also very important to understand to invest in Indian markets.
Okay. All right. Thank you so much, Rana Gupta there. With the kind of setup that we'll see, of course, the action, as far as we are concerned, takes place Thursday morning, but the caution ahead of that is very, very clear. And you could see that in fund flows yesterday as well. And let's just pull that up quickly, because you had a pretty good day, but spirits were flagging towards close, and especially on the Nifty. You had foreign investors selling about 1635 crores and domestic investors buying 754 crores. You know, frankly, when you look at yesterday, if you remove the euphoria around the Bajaj Housing Finance listing and a few pops here and there, it was a pretty dull day. Apart from that, you know, one counter and one IPO, which was fabulous, but the rest, you could see markets losing steam.
Maybe because Bajaj Housing Finance was so exciting, the rest of the market had to take a back seat, right? It could be the other way around, but yeah, it was a day of consolidation, but I don't think too many people complain, because a little bit of calm is good. You've got that big event, the outcome of the big event that markets worldwide are tracking very closely. It was volatile, consolidative, whatever you may want to call it. The range of the day was in about 110 points to be precise. We did close 60 points off the day's high. So midday, between 1 to 2, there was some buying. Towards the last half an hour, like Tamanna indicated, the markets started weaning off once again. Banks, metals and energy stocks did catch some attention from the bulls. Bank Nifty has been a little bit of a standout for me, because the outperformance there very slowly and gradually has begun. Bank Nifty closed comfortably above levels of 52,100 in trade. For the very first time since the 22nd of July, so the last 2 months, this is the first time that there's been a conclusive close on Bank Nifty. Apart from that, quick mention, Bank Nifty gained 1,100 points in the last 3 sessions. FMCG and telecom took a bit of a back step. Regulatory changes impacted how most of those consumption stocks did in trade yesterday. Stocks like HUL, Varun Beverages, Godrej Consumers were down and out, and the index itself lost about 1% in trade. A few stocks that stood out, Tamanna mentioned how the day belonged to Bajaj Housing Finance for all the right reasons, had a blockbuster listing, went home with gains of 135%, and the street still seems excited about this one from what we understand. Well, apart from that, you had the Adani Power and Adani Green both having a strong show in trade yesterday. Dixon rose about 8% to make a fresh 52-week high, and BSE gained 18%. Not sure what's going on here, but it gained on very healthy volumes in trade yesterday. From the get-go, the stock was looking good, finally going home at the day's high point in the session.
Just on BSE, so what seemed to have moved BSE is that over the weekend, NSE got a huge reprieve on one of the cases in the co-location scam. So the part of the case where 2 of their top officials, the CEO and the COO, were, being accused of colluding.
NSE.
In the co-location scam. SEBI withdrew that case. That's seen as paving the way for their listing, a re-rating of the whole space. So you had not just BSE or MCX as well up.
But
so
you would imagine if
up.
NSE eventually lists, which has now been in the works for maybe 3 years, if not longer, I would imagine it would be assets getting split, because for now you only have limited opportunities. The minute NSE comes into the secondary market, you would have just one more stock to invest into.
Correct, but then you also re-rate the whole space, like what you saw happening with Bajaj Housing Finance. You see Zomato up on a Swiggy kind of a news, and ahead of that listing, and that's what excited BSE. I mean, with those huge volumes, can't really see anything else.
No, that was the reason. Yeah. That was the reason. It is this NSE reason, frankly. But great volumes, good moves yesterday, and lots more up happening there.
And everything to do with, I think, investments in that sense was looking good. I think stocks like Edelweiss, JM also had a pretty decent run. But yeah, today's day looks quietish again, with maybe a small upside bias of that.
Yeah, consolidating, unlikely to trade lower. That's a safe assumption that we'll very likely not trade lower. But in fact, data suggests that to viewers. So we are very likely to trade sideways with maybe no negative bias. But the options data, just look at the options data, and the writers are telling you that we're not going to move too much. It's split at both ends, 25,000 and 26,000 on the put and the call side. Equal writing seen in yesterday's session as well and day before. So therefore, not too much not very heavy positions being taken as of now, relative to maybe 6 or 7 days ago when the put writers really stepped up. So it's kind of even Stevens, if you will. What seems to be certain is that one of the key movers in trade yesterday, which is FMCG, it may not be a day's trade. It may be maybe for a while. So while the defensives are stepping up, this edible oil thing might actually hurt FMCG stocks, HUL and some others, not just for one day, which is yesterday, but maybe a few more days. So that's to be kept in mind. And yeah, I mean, Tamanna and Samina spoke about a clutch of these names, but Edelweiss, BSC, Divi's may have been soft yesterday, but up for 9 straight days as well. Some crazy moves happening in stocks which are on a bit of a tear, and therefore bottom-up stock picking might well help you because the index seems to be going nowhere.
And hence it is, and that explains why a whole bunch of active fund managers have finally started outperforming passive fund managers on the investment side of the business. But yes, lots to watch. Today may be a quietish day. I think Bajaj Housing Finance may top our list again, but we'll talk about that in a minute. The indication on implied Nifty is a 33-point gap up. Opening 25,400 is really a level you want to track. Yesterday's trade was largely short covering led, so you want to also be mindful about that because that will determine the course of the markets over the next couple of days. Stocks across gold will look good, so anything gold specific will be one you want to track. You have a brand new stock or company that will debut on the exchanges today, PN Gadgil. Well timed given the euphoria surrounding gold prices right now. But a whole host of other names that we should be tracking in today's day of trade. First on my list is SpiceJet. This one's been quite a mover. Remember, the last 5 days, the stock is up 20%. Yesterday as well, the counter saw some buying emerging in trade. Well, the news is out and public. They are looking to raise 3,000 crores via QIP at 61.60 rupees a piece. The funds are being raised at a 20.81% discount to yesterday's close. But what you want to remember is that the stock has gained 20% in the last 5 days. So what it's going back to is the price that was trading at last Tuesday. Well, the plan initially by SpiceJet was to raise 2,500 crores through a QIP and about 740 crores through previous warrants and promoter contributions. SpiceJet will look to using these proceeds to, of course, fix the house. Operationally, there's trouble in paradise for SpiceJet. They will address liabilities, restructure with leasers, and expand their fleet. Numbers have been dwindling. SpiceJet's market share as of end of July has dropped to 3.1%. So this, while QIP or fundraising depends on how the markets want to view it, but in this case, I would imagine could be a positive, but who's to tell? The stock, because it comes at a 20% discount, may not impress the markets too much. The other one, which is a positive on fundraising, would be Sindoor Manganese. They've approved a fundraise of 1,000 crores via QIP. Now, what you want to remember on this is in April this year, they announced the purchase of 80% stake in Arjas Steel. Arjas Steel enterprise value then was 3,000 crore rupees. 80% of that would be required to be paid out by Sindoor Manganese. They hadn't disclosed how they would fund this acquisition. Some part of it could be internal accruals, the other part of it could be this QIP. And the period is 7 months from April that this deal has to be concluded. So Sindoor Manganese fundraising plan could be in order to complete the acquisition of Arjas Steel. The other one that you want to track is Torrent Power, and this is conclusively good news for the counter. MOU with the Gujarat government. The agreement is for a 5 gigawatt solar wind or solar wind hybrid project. The project will be executed in Gujarat. So 3 stocks on my radar: SpiceJet, Sindoor, and Torrent Power.
Okay, I'm going to start off with Bajaj Housing Finance, and you might think you've had enough of it.
You can end with that also.
Conversation of it, but so Philips Capital note out today, and I'm genuinely curious to see whether the momentum continues today after yesterday's run up. Do people now take some money off the table? Do
Just
they exit?
on this one, Tamanna, I don't know whether Niraj or you, either of you know, what is the circuit now on this? Is it 5%? Is it 10, 20? Has there been any revision on that? Because yesterday we did see that it briefly hit upper circuit. But I think that'd be one thing we should find out and tell our viewers, because the stock is one of the only ones that we'll be tracking in a big way this morning.
So I think 165 yesterday at close, and Philips Capital has a note out with they've initiated a buy with a 210 rupee target price, and they see an upside of further 27%. So 165. Just okay. For a minute, let's forget that this stock was at 70 rupees in its IPO. About 165 already, so 27% more as per Philips Capital. The reason they're so excited, all of the reasons actually that have been discussed but reiterated by this brokerage house. They say they focus on the ideal home loan segment. They offer loans with a ticket size of 5 million rupees. They are addressing 65% of home loan originations in India. The focus on the lease rental discounting segment is also something Philips Capital likes. They say in 3 years, the company will have a balance sheet of 2 trillion rupees. Their focus on salaried home loans is what they like, steady expense ratio. And they say as they scale up, this I found interesting, their AUM per branch is closing in on LIC Housing Finance. So now the peer comparison comes in because remember all housing finance stocks which were up because of Bajaj Housing lost steam and were sliding towards close yesterday. They say the AUM per employee is at par with Can Fin Homes, but borrowing costs are better than Can Fin Homes. So not only perhaps a good day, a thumbs up for Bajaj Housing Finance, but you could see pressure continue in LIC Housing Finance and Can Fin Homes. So that's one definitely to look forward to and see what happens with the counter today. TVS is the other one. So the company has launched its all-new Apache RR310, starting price of 2.75 lakhs. That's ex-showroom. And why this was important is because TVS needs a premium product when compared to its peers like Bajaj Auto, etc., and looking at their recent launches. So prices at a premium to 400cc of Triumph and Harley Davidson. And generally, the trend has been to bet on two-wheelers. Two-wheelers have been doing better than your passenger vehicles. So you could see a further slight upside on TVS. This is definitely a thumbs up for them as well. Vedanta is the other one. Now this is an important story. On 15th of September in the evening, there was a huge breach at their Lanjigarh facility in Odisha. The catchment area that they have within the aluminum factory was overflowing because of heavy rainfall. It flowed into the villages surrounding, and they've put a whole protocol in place about that. Quite dramatic pictures over there, as you can see, and we'll get you a more detailed report on this. Now, the company comes out and says that there has been no impact in their production so far, and they are addressing the process water storage facility breach completely. But having said that, you could see a bit of a downside on Vedanta because the whole issue has not been addressed yet. So a bit of that overhang could continue. So that is definitely one stock to watch out for as well. As a result, you had aluminum prices anyway globally also up yesterday. Metals were overall doing well, and this is something we were discussing yesterday as well, Niraj, that metals doing well despite the Chinese demand issues. Maybe for aluminum, this could be one of the reasons.
Yeah, let's see. Vedanta, though very likely, Tamanna, as you said, might face the bitter end of the stick today.
And just to now, I think, quantify that, the facility, I believe, contributes 26% to its EBITDA. So it's actually a significant facility.
Yeah, but independent of whether the alumina production gets impaired or not, because this is also an ESG concern, maybe that is the other. That's the other impact that might come in. So let's wait and watch. Very quickly, top 3 stocks on my list. Panisha Biotech is the first one. They've reached a settlement agreement with Sanofi India. Sanofi's agreed not to commercially launch the disputed vaccine in India. Well, I would reckon that any bit of settlement agreement could be construed positively for both ends, and therefore watch out for Panisha. It was up about 5% in trade yesterday, could be active today. Edelweiss is the other interesting one. Remember, Ardia bought into Edelweiss day before yesterday. Yesterday we hear White Oak Capital Asset Management bought not a very large stake, about 0.25% stake at 124 odd. The stock is at 130, but White Oak is as astute as they come, and therefore they having bought this after Ardia has bought into it as well, could make Edelweiss be an interesting stock in the session today. Though I must say the stock was off the day's highs yesterday. So bear that in mind. And tossing between two brokerage names. I'm choosing the UBS note on IGL and MGL, but you could also take Ola Electric, by the way, as the one to focus on. But let's work with this. UBS has upgraded IGL to a buy from a sell, a target price of 700. That's a substantial uptick there. And they've reiterated a buy on MGL with a target price of 2400. So that could be interesting as well. But, you know, Ola Electric could be in the thick of things today. Tamanna, with BofA as well, Bank of America, as well as Goldman Sachs putting out notes on Ola Electric with significantly higher target prices. So that's a stock to watch out for.
You know, Ola Electric is becoming one of those counters, Niraj, which has these huge variances in how the street views them. One day, it's completely seen as negative because their market share has shrunk. Even in the PME drive, the new version of FAME 3, or the new version of the FAME policy, Ola Electric wasn't seen as being one of the biggest beneficiaries, perhaps because of the dealership stamp requirement. But anyway, today could be a good day for the counter, no doubt. But let's focus on banks. The bank Nifty ended above the 52,000 mark for the first time since July 22nd, but the index has underperformed the Nifty in the last 12 months. Harsh is joining us to explain why the bank Nifty could be the next big bet to watch out for.
Well, could it, Tamanna? We've been waiting and waiting for the Bank Nifty to contribute or start contributing significantly to the Nifty. Now, just in terms of data, not really contributing in a big fashion. Over the last 12 months, 4 out of the top 5 lowest contributories or the worst performing stocks of the Nifty 50 have been lenders. Within that, Bajaj Finance, of course, but 3 banks, HDFC, Kotak and IndusInd, they've severely dented likely some of the very strong performance we've seen on the Nifty 50 index, which is up 25% over the last 12 months. The Bank Nifty, in contrast, up just 12.5%. And the Bank Nifty also the second lowest in terms of gainers on sectoral indices after the Nifty Media. So the second worst performing index on sectoral indices after the Nifty Media was the Bank Nifty. So clearly some bit of pessimism. Why is that so? First off, deposit growth has been the key overhang on the entire sector as well as on overall lending as well. Liquidity has been crunched and therefore your cost of funds, your cost of borrowing, cost of capital has gone up in terms of the way in which banks lend. They borrow either through deposits or through money market and thereafter they lend. And that essentially is what has gone up in terms of cost. Second is with regard to regulatory overhang. There has been plenty of regulatory action, including the most recent draft norms on liquidity coverage ratios for banks, which will further accentuate pain. And that's probably what's also weighing in on investor minds. And the third is asset quality. In Q1 FY25, we saw a little bit of a slip in terms of certain pockets on the asset quality front. Have to wait and watch how that plays out in Q2 and thereafter. But nonetheless, that's one thing which might also be on the minds of investors. But what's working? Credit growth has been very, very good. There's a favorable macro on the annual. You have rate cuts which are coming, which would likely ease liquidity as well to a certain extent. And valuations, essentially that's the key. Valuations are well below their 5-year averages, especially for the top rated banks. And they've been through a tough time over the last couple of years, at least most of them. And therefore, valuations being lower than the 5-year average is definitely a positive. That's how the valuations essentially stack up. SBI IndusInd at 1.5 times 1 year forward, but you're looking at HDFC at 2.4. You're also looking at Axis at 2 times, and ICICI Bank, despite being at 2.8, it's still below the 5-year average. That's the one bank which has done very, very well. So all stocks below their 5-year averages in terms of price to book value. And analysts expecting some of them to do very, very well. Something like an SBI and an IndusInd expected to do nearly 20% over the next 12 months. HDFC Bank, slightly lesser, 13%, but nonetheless strong on the kind of weightage it has on the Nifty. If it were to move 13%, will definitely move the Nifty. And ICICI, just about 10%, while Kotak is at 8. Those are some of the heavyweights, both on the bank Nifty as well as the Nifty, and the kind of moves that analysts are expecting to see on those.
Well, thanks for that, Harsh. And it's very important to highlight what the past suggests has happened to try and gauge as to what the future could have. But mind you, there are some challenges to this, particularly in a rate easing cycle. So what's happening? The Fed meet begins today. The market is currently pricing in a 62%. Let's first get the fact that the market is currently pricing in a 62% possibility after 50 basis points rate cut. The probability was 25% a month ago. Now, lower rates should ideally lift equity valuations, but it's not necessarily played out this way. So in 2001, the Nifty fell 35% after falling 25% in 2000. In 2007, the next easing cycle, the Nifty rose initially, but plunged 60% in 2008. 2019, the index had stayed absolutely flat. Now, it's just pertinent to highlight that both 2000 and 2001 and the 2007-2008 period were marked by economic events which could have taken the markets lower any which ways. So whether the Fed move was the catalyst, it's difficult to point that out. In fact, in all probability, because the economy was going through the period of extreme recessionary winds, the Fed action would have happened as well. Yes, right? So bear that in mind. The slight difference is that 2019, the index stayed absolutely flat. Now, we'll come to this plate in a moment. Can we just stick with the previous plate, please? So in 2019, the index stayed absolutely flat, and therefore, that might be a more relevant piece to the current time, because while there is a talk of a hard landing versus a soft landing, it's not decided as yet, or it's not confirmed that we are looking at a recessionary period, except for maybe China. And maybe to a certain extent, Europe is going through a slowdown. But a deep recession, quite like 2007-8 or 2001, no, not necessarily. Now let's move to the next plate, which shows what are the valuations. So the different years, 2000, 2007-8, 2019, and current. The Fed outcome was a rate cut, rate cut, rate cut. The trailing P back in 2001 was 15 times. In 2007-8 was 20 times. 2019 was 30 times. And the current period, 2024, the trailing P is nearly 31 times. The point is, the price to book is not quite as clear, if you will, because 2001, the price to book actually is not 17 times, 1.7x, by the way. 2007-8, 4.5x. 2019, 2.9x. Current, about 4.8x. Look at market cap to GDP, by the way. 30, 150, 75, and 150%. So on all counts on the valuation parameters, you could argue that this is the period which, if valuations were a reason for the market to cut, this is what will happen. But portfolio positioning is the most important one, and that's the last thing that I want to say here. So the Nuvama note says that they are maintaining a defensive bias. Doesn't surprise anybody. Expensive cyclicals, which is industrials, PSUs, autos, and metals, are the most vulnerable, a la IT in 2001 and cyclicals in 2008. And of course, they have a large overweight on defensives, which is cash cows and insurance and private banks. And again, shouldn't surprise. So net-net, a defensive strategy being played out by most. If 2001 and 2008 are anything to go by, we are looking at a steep correction once the Fed rate starts. Just feel that somehow the template might be somewhat different this time, maybe akin to 2019.
Niraj, just on that, I think the two reasons why things may be slightly different, because historically, Indian markets have not seen the quantum of domestic participation that we're seeing today, and China was a big story till very recently, yes. Right? So who's to tell? The resilience of D Street is just something else. And we'll see that and we've been seeing that with the primary market listings as well that our markets have been witnessing. There doesn't go a day in these days without a subscription opening or a stock listing. Yesterday, the day belonged to Bajaj Housing Finance, and you had two smaller ones, Cross and Tollins as well, that made it on the exchanges. They had a good listing too, stable listing. No euphoria, but nevertheless, a good start to that day. Today, all eyes will be on PN Gadgil. They will be listing on the exchanges at 10 a.m. A quick mention about what PN Gadgil is all about and what this issue was. This is a fairly large one. About 1,100 crore rupees was raised through their subscription of the IPO. The issue price was in the range of 456 to 430, and it was actually very well subscribed too. So PN Gadgil's overall subscription number came in at 59 times. What you also want to remember is the anchor investors came in pretty strong. Not too many global anchor investors, but a lot of the local institutions have subscribed to PN Gadgil. Well, it is expected to debut at a massive premium. From what we are picking up, about a 60 plus sort of premium on at 10 a.m. this morning is likely. PN Gadgil should be opening around levels of 306 to 309. Well, what is PN Gadgil? One thing that stands out about this one is it is a gold retail company, and the listing of this comes in at a time when gold prices are a record high. So lots of things working for the timing of this one. It is a jewelry store company, like I mentioned, with a dominant presence in Maharashtra. So they're very significant in cities such as Pune. Maharashtra is we're making them the second largest organized player in the state. When they're looking to raise these funds, what they're going to do is they're going to be working on expansion. Their plans for now is to keep the business local in terms of focused in Maharashtra. 12 new stores will be added. Some part of the fundraise will also be used to repay debts. In terms of valuations, it's not too expensive. It's largely in line with most of the players. Of course, the gold jewelry companies have outliers such as Titan and Kalyan, but the rest of the market is in line with what PN Gadgil is at in terms of valuation. So all in all, should be a stable listing. A 60% upside is expected, which by no means is a weak one. So all eyes will remain on this one this morning, guys.
Absolutely. So, I'm curious about PN Gadgil, especially because it's not a pan-India name. It's very focused on Maharashtra and Pune. So let's see what kind of valuations it gets. But talking about moves that investors have to make today, I think the futures and options strategy becomes very, very crucial for the next 48 hours. Samina, what are the indications there?
It's going to be a standard morning, Tamanna. It will be a morning of consolidation. Don't expect too much on either sides on the index. And data is indicating that too. So let's take a look at what happened yesterday. Of course, you saw a very volatile trade, 110-point range on the index. We closed 60 points off the day's high point. This morning, we have an indication that what you saw on the Nifty is largely backed by short covering. So Nifty futures are trading at a premium. There's a decline of nearly 3% in open interest. So while the consolidation is with a clear positive bias, and that's the expectation, what we can clearly see is that bears are covering their shorts as we go into the big event over the next 2 days. Well, so no major up move expected, but the downside at least remains rather limited from here. Bank Nifty also indicating to a similar picture. September futures are trading at a pretty significant premium, and the OI is down about 4%. So the open interest sees a decline, once again telling us that bears rather have covered their shorts on expectation that the Nifty and Bank Nifty could see an upward journey. Not too much aggression in terms of fresh longs, but not too many shorts either. Bank Nifty itself is up 1,100 points in the last 5 trading days and has seen a record close, the first time on 52,000 close since 22nd of July. That's the open interest distribution, as you can tell, and those are the levels you want to be tracking. As obvious on the screen, 25,400 remains very, very active in terms of call writing. Maximum call interest, open interest has been seen at levels of 25,400, indicating that that becomes an important level that the bulls will try to take out and trade. On the downside, or in terms of the put action, 25,000 is quite active. So the trading range really remains with 25,000 on the downside, where we are seeing max put OI, and 25,400 is where you're seeing max call OI. Apart from that, a little more action was visible on the 25,500 calls, followed by 25,600 and 25,700. On the put side, beyond 25,000, 25,100 and 24,900 also saw some activity activity picking up on the put side of things. So largely range bound. The data is telling us exactly what we've been seeing on the street. So no major sort of surprises jumping just yet in terms of trade. Well, a quick check of what's happening in terms of stocks and where have we seen all the action. We did see how consumption stocks got it quite bad in trade yesterday. Stocks like Godrej Consumers saw aggressive short built up. We did mention, Niraj indicated that how the sell-off in consumption was not going to be one day, and hence what you saw in terms of stock action as well is indicative that the pressure on some of these consumption names could continue for the next few days. Birla Soft, LIC and Apollo Tyres also saw some short built up. Syngene International, on the other hand, has seen fresh longs being created. Apart from that, BHEL, HUL, Bajaj Auto, SAIL have seen some long unwinding, and you've got SAIL that's actually seen some short covering. So metals may be in a sweet spot, but largely speaking, I think the short covering remains to be in the FMCG and consumption space. So that's what we have in terms of the setup this morning. Amit Goel joins in with his top trades. Amit, it seems like your Bank Nifty and Nifty futures are at a premium, but there's a decline in OI, very clearly indicating short covering. From where we stand, would you consider initiating a fresh trade on either the Nifty or Bank Nifty?
Hi, good morning, Samira, and thank you for having me again. So I've been bullish on both the indices for some time now, and traders who have adhered to this stance have kind of made money. However, I do see that just before a major event like the Fed meet, which is going to be momentous, I would try and stay away if possible from the index investments, from the index trades. So I do see 25,000 as a major support for Nifty, and since the near-term resistance is around 25,400, which also happens to be close to our ATMs, I do believe that the upside for the time being, for the next couple of trading sessions, might be limited. So any dip at 25,000 in the next couple of days could be an opportunity to build fresh longs in the major index. Whereas in Bank Nifty, if you see, I have a similar view, though I have been bullish on the counter and have suggested a couple of bullish trades in the last 2 weeks, which have made money. Right now, I do see that it has, the run-up has been clean and is now close to a resistance zone. Hence, I would advise traders to, set up a very short-term trade for the next 2 days. I do not want to have any major position in Bank Nifty or the rate sensitives going into the Fed meet. The trade here is very simple. I'm playing for the downside with absolute protection on the upside. The trade is put ratio spread with a bearish view, in which I will buy a lot of 52,100 put of this expiry, which is the 18th of September, and we will sell 2 lots of 51,800 put. Now, if the index moves, gradually on the downside in the next couple of days on account of profit booking or anything, the traders would end up making good money, a good return of about 2,500 on this. We will also keep a rupee stop loss of about 2,500, making this a trade 1:1 sort of a trade.
Right, Amit, you've got an interesting strategy on Reliance Industries as well. Can you help our viewers with the strategy and what is the view? And also, if I know this is on the option side, if you've got a trade, a similar trade on the future side for RIL, that should be useful too.
The way I'm trying to play RIL is essentially on account of theta decay, in which I do not see RIL moving very, very sharply, because the entire focus is currently on the metals space. If you remember, we had a Jindal Steel long trade last week, which also played out. We also, the focus is also on the rate sensitives like FMCGs, like the banks, financials. So I'm trying to, play a little safer game here going into this major event. Hence, I'm suggesting traders to construct a non-directional limited risk trade, in which the trade here is an iron condor, in which we will sell 1 lot of 3,000 call and 2,880 put, and we will also buy the hedges. I generally prefer doing the short strangle, but since the event is on our heads, I will prefer to have a limited risk setup, in which we will buy hedges of 3,040 call and 2,840 put. The trade here will aim to make about 3,000 rupees as profit, and we will keep a rupee stop loss of 3,000. This is purely a premium decay, a time value decay trade. Hence, playing this in futures is going to be difficult.
Right. Thank you for that, Amit. That's premium decay or time decay strategy on Reliance Industries. Amit also has a trading call on Bank Nifty for a limited time period of 2 days ahead of that big event that's lined up, but largely constructive on both indexes. Thank you, Amit, for joining us today. Well, with that, Tamanna, Niraj, it's over to you guys.
Yeah. Okay. Thank you for that, Samina. And, we've been talking about the big stories this morning. Another one that we should be focusing on is Vedanta. They've issued a statement that a water storage facility at their Lanjigarh alumina refinery in Odisha overflowed due to heavy rains but has not impacted production. Mihika is joining us with more details. Now, Mihika, the pictures coming out of Lanjigarh are quite something. But just to understand, Vedanta says production has not been impacted thus far. Can we assume that this concern is behind them, or could there be an impact going further?
So they are addressing the situation, but it has not been entirely dealt with, and they're following the protocols necessary. Now, the breach happened on September 15 due to unprecedented rains in the area, and extreme weather caused the water levels as well as the pressure to rise in the catchment area, which led to the breach. Now, the facility is built to international standards and regulated and monitored by digital and manual tools according to the company. But we did see aluminium future prices rise around 3% because the alumina refinery is very key to production of aluminium, because it's a key raw material for aluminium production, and it's already a very short supplied market, and this comes in when global alumina prices are very high. Now, the company has said that no injuries or loss to livestock has been reported so far. The overflow has impacted the surrounding agricultural areas. However, the company did initiate immediate containment and mitigation measures and told the state administration, but no disruption to current operations so far. The refinery continues to operate, and there was no damage caused to the red mud storage facility as well. A little bit about Vedanta's Lanjigarh aluminium and alumina refinery. Now, the refinery is a part of the largest aluminium installed capacity of 2.4 million tons per annum, and the FY24 aluminium and alumina production from this refinery itself was 2,730 and 1,830 kiloton, and the FY24 EBITDA of this refinery stood at 9,657 crores, which is a 26% contribution to EBITDA. And the company has been focusing on expanding this alumina refinery because it helps reduce costs from the raw material front.
Okay, thank you so much, Mihika, for all of those details. Vedanta want to watch, but there are a lot of other stocks that should be on your watch list. So here's the NDTV Profit watch list this morning. On the upside, with good news, is Wari. The arm has started their 3 gigawatt solar plant in the US, a module plant in the US, so that could be an upside for the stock. Torrent Power, it's an MOU that they have signed for a 5 gigawatt renewable project. Globus Spirits in focus, they launched their first single malt whiskey. Panesha Biotech, they have a settlement agreement over a patent infringement that will be seen as a positive. Bajaj Housing Finance again in focus. Phillips Capital has a buy call out and sees a 27% upside with a target price of 210.
Sandur Manganese has approved a 1,000 crore QIP. SpiceJet is going to raise 3,000 crores through a QIP, and Samil is going to raise 6,400 crores via QIP. The lower two, if the fundraising is successful, could be constructive for both the stocks.
Okay, on the negative news flow is Vedanta. The alumina facility, which contributes 26% to their EBITDA, has witnessed a water overflow breach. So those are some of the stocks that are on the watch list today. All right, let's start off our conversations for the morning. Rajat Bose with us, SEBI registered research analyst, and Sunny Agarwal, head of fundamental equity research at SBI Cap Securities. Welcome to both of you, and great to speak with you today. Rajat, let me start with your take on the indices. The Bank Nifty actually showing more promise than the Nifty, you would say. Would you be taking any positions ahead of the Fed meet outcome?
Well, Bank Nifty has clearly given a breakout signal, and it has closed above the 20-day Bollinger Band. currently at 52,153. If it crosses 52,400, then there would be major movement that can happen. Next step will be 52,525 to about 52,600. Let it cross 52,500 decisively. After that, we can think of whether Bank Nifty will come up with a press high or something. But as of now, one should put a stop loss below yesterday's yesterday's low, that is 51,921. If I'm not mistaken, it is the level below which it will become weak again.
Okay, so Rajat, you don't sound too constructive. Just trying to understand if you would sit on the sidelines as opposed to going long on the Nifty or the Bank Nifty. Part 2, what are the stocks that you're recommending in the session today? Good morning.
Well, just to talk about a bit about the Nifty, unless the Nifty takes out 25,422 to about 25,450 range, I don't think you should be attempting to go long. Beyond that, you can always go long and putting a stop below yesterday's low. The two stocks that I have chosen today, first is IGL, Indoprostho Gas. The reason behind choosing Indoprostho Gas is that whenever this stock, either it comes close to the 50-day moving average or it breaches. This time the breach has been for the 3 successive sessions, and yesterday there was a good upswing that has happened and it closed at 529.85, while the 50-day moving average also has been taken out. So on the upside, the targets are 534, 539 and 542, and the stop loss should be below 522. The other stock that I've chosen is Larsen & Toubro. Larsen & Toubro has crossed all these moving averages, 9, 20 as well as 50. On Friday, there had been a little bit of an indecision and it closed below the moving averages. Yesterday, it moved up strongly. Volume was okay, sort of. So I put a stop loss at 36.18, 36.96 and 37.27 are the two targets for Larsen & Toubro. Larsen & Toubro, once it crosses 37.25 to about 37.50, then you can see even crossing or at least testing 3800.
Okay, so those are the top picks this morning. Sunny Agarwal joining us in as well. Sunny, is this a good day to take positions on banks if you're expecting banks and IT? How would you look at those two buckets? With a 25 basis point rate cut pretty much clear on the horizon and an upside possibility of a 50 basis point rate cut from the Federal Reserve.
Yeah, good morning, everyone. I think, yes, definitely 25 basis points is something which is on card and that has been discounted by the market. Anything above 25 basis point will be definitely considered as a positive, at least in terms of narrative that now a rate cut will be very aggressive going forward. And I believe the RBI will also follow the footsteps of US Fed maybe beginning Jan next year. So yes, definitely positive for NBFCs rather than banking, non-banking finance companies, because they are the first that will benefit in terms of lower cost of fund, and at the same time their NIM is likely to expand during the downward trajectory of the big key benchmark rate. So I feel rather than focusing on banks, one should focus on non-banking finance companies, NBFCs. And obviously, the second rung of beneficiary will be banks, wherein the pressure to increase the deposit rate may ebb to some extent. And within bank, I would like to bet my money on large cap banks, where we have seen a kind of underperformance since last 3 to 6 months. So banks like ICICI Bank, Axis Bank, or for that matter, IndusInd Bank, and HDFC Bank, with a caveat that it may take a quarter or two for a merger benefit to come on full stream. So these are the few private sector banks which we like from short to medium term perspective.
Okay, now it's a day of fundraising, right? 3 fundraise exercises. But let's focus on the one which was the most interesting, according to me at least, and that's SpiceJet. It's set to raise up to 3,000 crores via QIP. The indicative issue price comes in at a discount of 20% to its closing price yesterday, which usually I would say could be construed as a negative. In SpiceJet case, could it be different? Well, let's first get in Mahima to talk about the details of the QIP. Mahima.
Right. As you rightly mentioned, SpiceJet is set to raise 3,000 crore via QIP. Now, they had already passed a resolution that they will be raising 3,000 crore in July itself. Now, the indicative total issue is 3,000 crore, but the base issue is 1,500 crore and green shoe option is another 1,500 crore. Now, the indicative issue price is set at 61.6 per equity share, which is at a 4.92% discount as compared to the SEBI floor price. And the yesterday's closing price was 77.79 for SpiceJet. So overall discount as compared to the yesterday's closing price of the stock is at 20.81. Now, in terms of dilution, well, post this QIP, there will be 38% of dilution in terms of paid up equity share capital. And in terms of indicative timelines, where it did open yesterday, that is 16th of September, and it will close today, that is 17th of September. Now, why the QIP? Well, it's a debt-ridden airline, and had indicated already plans to raise 2,500 via QIP and 736 crore via previous warrants and promoter contribution. Now, SpiceJet may use these proceeds for addressing their liabilities, for restructuring with the lessors, and expand their fleet by reviving grounded aircraft and aiding new planes. Now, SpiceJet market share has plunged over 3.1% in July itself. So it's going to be interesting to watch out for what SpiceJet is going to do with such kind of fundraising.
That really is the big question, right? What will they do with the fundraise, and is it going to be sufficient to get the airline back to where it needs to be? Now, it is the season of fundraisers. Samvardhana Motherson has also announced the details of its QIP. They are issuing compulsory convertible debentures of face value of 1 lakh each. The floor price of the issue is 188.85. The company has a net debt of 16,000 crores as of 24 June, and promoters owned 60.36% in the June quarter. So, a fundraise there coming in as well. Sunny, just wanted to get your take on the whole fundraise and how, it's sometimes the street sees it as a positive, and sometimes it's seen as a big negative. In SpiceJet's case, in the kind of run-up that we've seen, the kind of pedigree of investors that are coming in, would you be constructive at all on a SpiceJet?
SpiceJet definitely fundraise was something which was necessary for the company to increase the number of fleets. Basically, we have seen that the operational fleet has reduced from 74 in 2019 to close to 28 in 2024. And at the same time, although the company is EBITDA positive, what we have seen that due to the higher cost of working capital and outstanding payment dues, that is leading to losses at PBT level. And I believe post this fundraise, they will able to again make the grounded aircraft operation, and that will lead to the lot of positive momentum as far as operational numbers are concerned. In terms of demand, I think there is no doubt that demand continue to remain pretty robust, and that is the reason we are seeing a blockbuster number by Indigo, which is the largest player by market share. So again, I believe the story is very similar to Vodafone, where it's a work in progress turnaround story. Company need to mobilize fund to ensure that all the fleets are operational, especially on a profitable route. So I think it's a high risk, high return kind of bet. Somebody want to bet on a turnaround story can definitely look at SpiceJet as an allocation to the turnaround bet.
Rajat, on the charts, do you like SpiceJet at all? Do you see a short-term trade here?
Tamanna, the short-term trade was on 12th of September. But after that, yesterday as well as on Friday, the kind of move that has happened, even the 9-day exponential moving average, the SpiceJet closing price is more than 10% above that. So at this level, the risk is too much. So any fresh trade cannot be taken. But if you have already purchased, those who have already purchased, they can continue to.
Okay. We missed that last bit of the answer. Your feed froze, Rajat. I'm assuming you said if you've already purchased, you can continue to hold. Was that the take?
Yeah, those who have purchased, they can continue to hold, but look at the history of QIPs. What has happened? If you do look at that, then if you are making a bounty in the short term, or you have purchased it around say 55 or so, and you are making good money, if I were in their position, I would have good profit.
Okay. All right. We'll take a very short break, but we'll be right back with the pre-open. And your first cut of strategy is for what could be quite an exciting day. Stay tuned. We'll be right back.
Well, India market open will focus on what the market could do, not just today, but over the course of the next 3 trading sessions, because a lot of market movement would be derived from the Fed action and the language. Until then, maybe a bit quiet. So you probably see 2 days of a quiet session or sessions and then some activity. Here come the first rates, of course, but this is just the pre-open session. We'll get to the normal rates in about 8 minutes, but suffice to say, we might start off marginally higher. The question only is, can we pull up post that? So I think we'll try and figure that out. One of the key stocks of, actually 2 key stocks of yesterday's session, and I think both of those need to be discussed. One of them is Bombay Stock Exchange. The stock of BSE was up about 17%. The other one is Adani Green, which was up about 8%. So 2 large names, and both those had a very, very strong move. I'll start off with the first one. Sunny, with you first. On Bombay Stock Exchange, there's partial relief to NSE in one of the co-location issues, and the fact that if the IPO is coming, the sector gets formed. If one of the indices has to be taken by NSE, then BSE gets the other index, which might also be constructive. So lots of possible triggers out here. Are you constructive on the prospects of BSE, the stock? Why or why not?
Yes, definitely, Niraj. I think yesterday's move was more of a rub-off effect of upcoming NSE IPO. I think all the hurdles are clear now for NSE IPO. And at the same time, the likely regulation of restricting the number of weekly expiry as well as monthly expiry, that will augur well for BSE as an company, because right now what is happening is that BSE has got a lesser contract which will go out of trading band post this in case this new rule is implemented. So I think all the concerns surrounding the impact on the business due to a likely restriction on FNO trading, that is something that concern has waned a little bit, and BSE continue to report a very healthy set of number. And obviously second trigger is likely listing of NSE maybe 3 to 6 months down the line, and that is having a rub-off effect on BSE. At the same time, markets at lifetime high, obviously that will have a many positive impact in terms of volume as well as overall sentiment. So all these factors are playing together as far as BSE is concerned, and I feel it's a more of an long-term story. The entire capital market as a bucket, whether it is exchanges, stock brokers, wealth managers, asset management companies, the trade settlement companies, all these are likely to do well for next 3 to 5 years.
Yeah, well, point well noted. Sunny, thanks for that detailed answer. Now, Rajat, I want to come to the other one on you. Adani Green. Both Adani Green and Adani Power went up, but Adani Green in particular, because of a very large contract, 26 gigawatts of capacity tied up. Investec today as a note, the target price of 2550 went up 8% yesterday. You think Adani Green can do more? Is there a trade here? Rajat, the question is to you. Okay, I don't think Rajat Bose can hear me. Sunny, tactically or from a long-term perspective, does Adani Green fit the bill?
Yeah, I think valuations are something which is not comfortable. But again, for Adani Green, what has happened is that their new facility of solar that is at Khadwa, Gujarat, that I believe will be a big kicker in terms of earning growth for Adani Green. And obviously, the contract with Maharashtra government again augurs well for Adani Green, at least in terms of earning growth visibility. Valuations are something where we are not comfortable as far as Adani Green or any other Adani group.
Well, but big move there yesterday. And you know, guys, the other thing that caught my attention was that in this note, I think the Investec note, the analyst is saying that from FY24 to FY30, the CAGR numbers, I think 30% for revenues, 60% PAT CAGR from FY24 to 30. So I think that is the really impressive thing. If the company manages to do that, what could happen to its multiples, which may look expensive currently, but how they start looking once you look at FY27, 28, if indeed that 60% CAGR assumption turns out to be true.
Absolutely. All right, the other stock which is in focus this morning is Ola. And Puneet is here to join us on the top brokerage call, which is Goldman Sachs on Ola Electric. Puneet, what are they saying?
Well, you know, very positive commentary coming in from Goldman Sachs. They've initiated the coverage with a buy target price of about 160 rupees per share, which is a 48% upside from the current market levels. Now, they have said that, you know, the company is building a local formula for growth going forward as well. And also specifically in the two-wheeler segment is disrupting the market. Specifically, it's viewing the company as positively levered for long-term growth in the electric two-wheeler space and seeing, you know, structural strong trends going forward as well. The three segments, you know, the three things about the company, they are very positive on in-house battery manufacturing, launches by the incumbents as well as FCF generation going forward as well will be some of the things to watch out for, as well as the key factors to achieve this price target that they mentioned. Operating leverage, you know, in fast growth phases by incumbents previously, you know, bodes well for someone like an Ola Electric to follow the same path going forward as well. Finally, they're expecting FY24 to FY30 revenue CAGR of about 40% going forward over the next 6 years. And I mentioned that, you know, this particular price target is implying free cash flow generation as well as break even by somewhere around FY30. They are expecting, you know, EBITDA margins of about 11.9% by the same time FY30, as well as return on investment capital will also be at a very healthy 27% going forward. Although they have said that the valuations are high, EV to sales trades at about 6 times currently for the company. And they are mentioning that, you know, the other Indian two-wheelers are trading between 3 to 6 times versus someone like a Tesla also they are making that comparison with, which is also at the 6 times. So not extremely expensive since, you know, it's come down from that 157 rupee mark. But still, you know, the FCF generation was only coming by FY30, but really positive brokerage note and target price upside coming from Goldman Sachs. Back to you.
Right, Ola Electric, brokerage upgrade. The stock will be on the radar, pre-open indicating to 5% upside in trade. Rajat, it's an early listing, so not sure whether you'll have much on it. I'll talk to Sunny about it in a minute. But since I've come to you, you want to start by telling me how you feel about some of these consumption names that fell off the cliff yesterday. Godrej Consumers, HUL, ITC, while there was no fundamental impact on the stock, it did correct. Any of these consumption names that look good to you on the charts that could be bought for the near term?
Well, I would say that if you look at Hindustan Lever has been, it was on a tear and it was moving up consistently. crossed, say, something like 2,900. Yesterday's fall, I'm not reading too much into it because it has not fallen below 2750. Only if 2750 is taken out. And look at the close yesterday. Look at the close yesterday. It is far higher from the lows. The lows had been 28. Yesterday's low was around, say, 2807, and finally it closed at 2867. So you can definitely look at Hindustan Lever. Apart from that, you said Godrej Consumer. Godrej Consumer, again, it is bounced back. See, all of the counters, especially in the FMCG space, there had been some profit taking, but they have bounced. So once again, you can bet on it. But if I were to bet, I would bet on Hindustan Lever.
Bet on HUL. Sunny, how do you feel about Ola Electric? There's an upgrade coming from Goldman Sachs. Pre-open is indicating to a 5% uptake. Constructive on the stock at this price?
Yeah, on Ola Electric, I think one need to track month-on-month market share because what we have seen in that all the incumbent players like Hero, TVS, they are giving a tough competition, and at the same time in terms of pricing at the lower end of pricing band, that is 70 to 80,000 rupees, incumbent players have also launched their product. So I think market share is something which will matter going ahead. No doubt, June quarter numbers, we have seen a significant improvement as far as EBIT level margins are concerned. So from -8 to close to -2% on the verge of break-even. And going forward, obviously, the launch of a motorcycle as well as the response to that from Jan 25 and integration of the own battery into the vehicle will lead to the expansion in margin. So I would like to be in wait and watch mode rather than preempting the turnaround in the performance. As of now, I feel the best way to ride the EV story, EV two-wheeler story is Hero MotoCorp as well as TVS Motor.
Okay, focus also on some of the India utilities that could be in spotlight today. Jefferies has a note out where their top picks are NTPC, JSW Energy and Power Grid. That's because they say that the Finance and Power Ministry's policies are helping reduce state electricity board losses, and losses are down for state electricity boards to 0.39 units versus 0.84 per unit, say from a decade ago, and they've picked the FY13 to 23 period for this. They say that the health of state electricity boards and cash flows will power key companies in the sector. Tariff regulations also bode well. So they have picked some of their specific companies, and let's see how some of them are doing this morning. NTPC, Power Grid, JSW also they see as a beneficiary as well. But I think the other note which was also important this morning is the UBS note. They have upgraded IGL to a buy with a target price of 700 rupees. They have reiterated a buy on MGL with a target price of 2,400 rupees. Both those stocks up in the pre-open session at least. They're saying the consolidation trend in CGDs, that city gas distributors, could continue, and in organic growth prospects and strong near-term fundamentals should support further re-rating. Rajat, a view on IGL and MGL, at least the pre-open reaction seems positive. And IGL I know you talked about as well. That's why
IGL I have already given my IGL I have already given my it is one of the two top picks. MGL again may not be as bullish as IGL, but MGL, it needs to take out 1835. If it manages to do so, in that case 1858 to about 1867 you can expect. Regarding say if you look at Power Grid is trying to get past say 335 to 340 kind of range. Once it manages to get past that, then there would be some good movement here. And regarding NTPC, I would say this is the stock, apart from IGL, this is the stock that looks really good. I actually took a choice that whether NTPC or IGL. I voted for IGL in my 2 stocks, but NTPC also looks pretty good because there is a bullish moving average crossover, and now it can actually at least test something like say the higher end of the Bollinger Band, which is around say 419. If 419, 420, these levels are taken out, then there could be a move towards 427 to about 430.
Another stock that I want to actually, why don't we talk about IT before we go into Zomato? Anything in the IT pack that's looking good at current levels? The big event is in there in the next 2 days, and usually global facing companies land up doing better in the medium term. At least that would be the expectation. Anything in tech that you're still constructive on?
Is it for me,
Rajat,
Samina?
it is for you, yes.
Well, I would say that TCS could be one of the stocks that you can look at, because TCS has been in a range, and once there is a breakout above, say 4600 supply zone, then there will be a good move on the upside that can happen. Apart from that, you can look at KPIT Tech. KPIT Tech might give a good movement because it is in a range-bound situation and it has tasted its 50-day moving average yesterday. Each time it tastes 50-day moving average, it gives a bounce back. So KPIT Tech and TCS would be the 2 stocks. I personally avoid talking about Tata Tech and LTTS because they are in my portfolio and I've transacted in them. You can ask Sunny about the other companies.
Fair disclosures, Rajat, and we'll do that. We'll probably ask that to Sunny as well, but just 45 seconds left, so we'll probably avoid that for now. I dare say, watch out for SpiceJet, Samvardhana Motherson. If you can just pull up those pre-open price of a SpiceJet, Samvardhana Motherson, and Sandur Manganese very quickly before we get to the market open, because all of those 3 are QIP boys. SpiceJet marginally lower. Samil should come up on your screen next. And Sandur Manganese 1.95% higher, in fact. Samil, well, holding up. So SpiceJet is the only casualty of QIPs thus far. But here come the first trades this Tuesday morning on the day when the Fed meet will start. Here's how the markets have started off. Flat as flat can be for the markets. The Nifty IT should come up on your screen, and the mid caps and the small caps should come up on your screen next, because the benchmark indices seem absolutely flat. IT flat too. Mid caps and small caps, are they outperforming? No, not really. The market breadth would be even Stevens. Let's get the heat map up on the screen because it's absolutely flat. Tata Motors reacts a little bit, 1.78% lower for Tata Motors. I don't know if I missed a piece of news here. HDFC Life correcting for the last few days. I think autos and four-wheelers, in fact, all autos, iShare, Bajaj Auto, Maruti, Tata Motors, all of them in the red. HDFC Life continues to correct. Even Stevens on the quantum of red and green. What's gaining is metals yet again. Hindalco up 1%, or commodity stocks led yet again. ONGC up about 0.74%. Crude prices have gone up to 72 odd. FMCG at least selectively is making a bounce, because I saw Tata Consumer in HUL and Britannia in the green. A surprising move, maybe a bounce back, because most people stated that this might not be just ending in a day. But net, metals and FMCG on the gaining side, or commodities and FMCG on the gaining side. Autos is losing out. Some bit of weakness in IT too, but Tata Motors stands out with this 2% fall.
And it's a very range-bound kind of morning, I would say, Niraj. Very cautious kind of a start to the day. Let's pull up the broader indices and see what is the action there as we kick off as well. Yeah, in terms of key sectors, oil and gas just showing some kind of a move there. FMCG may be bouncing back, but it's auto that is being pulled down. Auto and reality, perhaps because of Tata Motors on the auto side. But let's pull up the mid-cap and small-cap indices. Completely flat. Nothing exciting happening there this morning. Everyone's waiting perhaps for Thursday to take a position, to take a call. Even the small cap 215 not really moving much. Let's look at stock specific news. Dixon, wanted to pull up Dixon first, was buzzing yesterday. Motilal Oswal now has a buy call with a 15,500 target price. Stock is down, really seeing some profit booking after yesterday's rise as well. Wari was the other one that we were looking at this morning. The company has, their parent actually has started a 3 gigawatt solar plant in the US. Back on that news, the stock is up 5%. Ola Electric, we've been talking about, very, very bullish call from Goldman Sachs. Not a very bullish move, at least right when the stock has started in the first few minutes or so, about 3.5% up this morning on Ola. IGL and MGL are the other ones. Are they moving on the UBS note, the brokerage call? Yes, they are. IGL more than MGL. Remember, it's also Rajat Bose's technical call this morning on NDTV Profit. 5% up on IGL and MGL, about 4% up. Bajaj Housing Finance has the superstar of yesterday maintained its upside. Yes, it has 10% up, already on the circuit as it moves 181 rupees on Bajaj Housing Finance. Is it Phillips Capital or is it all of the people waiting in the wings for a piece of this pie? But yes, it's again the star of this morning. SpiceJet QIP, in fact, SpiceJet, let's look at Motherson Sumi as well. Both stocks down, SpiceJet more. Maybe a bit of reaction to yesterday's upswing as well. 5% down on SpiceJet. Samvardhana also over 0.5% down. So once again, folks, the standout seems to be Bajaj Housing Finance, isn't it?
Yes, it is another quiet day with Bajaj being the star. So not too much in terms of supporting cast this morning. The market is quiet, like Tamanna and Niraj have indicated. You have 2 block deals have happened. Tata Motors, 0.4% of equity has changed hands. So that's a big one. That the stock will be one you want to track this morning. And Samvardhan Motherson has also had a block that hit the street just a few minutes ago with 1 million shares changing hands. The stock trades flat. The 2 big gainers on the Nifty 500 come in from those UBS upgrades. It's IGL and NGL. But what's actually jumped up is Carbodium Universal, which is now up 5% on not great volumes, but it's actually moved up quite well. Apart from that, Thermax is a company you want to track. They had some recent order wins, a lot of action on the company. The stock is up 3%. Tube Investing, Trent is up 2%. Midcap Pharma isn't doing too badly. JBM Auto is having a positive. So it's all very random. There's no major trend that's emerging just yet. And there aren't too many stocks either that have news flow that's driving them. Torrent Power could be one you want to track. SpiceJet, Tamanna has already highlighted for you. Sandur Manganese, they're also looking at an aggressive price. QIP, fundraise of about 1,000 crores. SpiceJet not doing too badly. 3% off, even though the block is going to be at a 20% discount to yesterday's close. Sandur is looking to raise 1,000 crores. The stock is actually a top gainer this morning. It's up 3%, and the volumes aren't doing too badly either. So the broader market is where you'd expect some action this morning. But like we said, it's very, very muted. There is consolidation, though with some downside bias. Remember, yesterday's movement was largely short covering led. No fresh longs were initiated in trend too aggressively, and hence you are seeing what you are. When Tamanna highlighted, Ola Electric was up about 3.5%. It's picked up some more gains since then, now 4.5% higher on Ola Electric. But I think the stock of the morning is Bajaj Housing. Aarti Surfkins, if we can get that one on the screen, the stock is up quite well, and I think 9% higher on Aarti Surfkins. So chemicals, specialty is a space that's looking good. E-cost, mobility also trades higher. Kohinoor Foods is up 12%. So there are gainers. They're all over the place. But Asia Biotech, which Niraj had highlighted this morning, trades with a gain of 6%. India Shelter is also trading marginally higher. So you have some movers, Tamanna and Niraj, but no serious standouts this morning apart from those 2 UBS calls and Bajaj Housing stealing the show. We have Pay and Gadgil at 10 o'clock. They may get a good start, so may sort of Bajaj Housing may have to set the attention as another Pune player.
We should see what's happening to Tollins and Cross. I mean,
yes,
I think we've been very unfair to Tollins and Cross. How are they faring on the day after listing? Let's pull up 2 of the newer companies. I mean, the other debutantes yesterday, and no, Tollins Tires is again not having a very good day, but 4.5% down. Cross is okay, about 3.5%, 3% up. So It's all about Bajaj Housing Finance. Again, it's hit the 10% circuit. Yes, the circuit level is at 10%. Sunny, I have to come and ask you, what would you do with the Bajaj Housing Finance right now? I mean, if you have it and if you don't have it, both ways.
Yeah, I think for Bajaj Housing Finance, one need to keep in mind that post at current market price, maybe stock is trading at 6x price to book. But at the same time, in case the company is able to maintain the growth trajectory of 25 to 30% CAGR, then if I take a 3-year forward number, maybe it's trading at 3x price to book. And in case the company is able to sustain this high growth rate of 25% for maybe more than 5 years, 10 years, then I believe the premium valuation can sustain in Bajaj Housing Finance. And historically, we have seen the similar valuation playing out in group finance or swile entity of HDFC, where it used to trade at 9 to 10 times price to book, although the NIM and ROE were totally way above the Bajaj Housing Finance in the current avatar. So I think if somebody is looking for 20-25% kind of CAGR growth story, I think Bajaj Housing is the one stock where one can look at. Maybe not now in the euphoria post listing, maybe post 1 or 2 weeks when the euphoria die down, stock goes off the radar. At that time, there may be some pullback, and at that point of time, it can be added in a medium to long term portfolio.
Rajat, quickly, anything that stands out on open for you?
Well, definitely these newbies, the Bajaj Finance and all, they have moved up. Only thing that I can say about them is that you just have to go back since Tata Technologies or even Ola Electric. So I would be pretty wary of buying these newbies right now. But if you are interested in a stock that is doing well, in my opinion, apart from the NGLs and IGL twins, it is Escorts Kubota. It is already up nearly 1%, and it is going to move up because the moving averages are giving indications that beyond 39.10, dash towards 4,000 might well happen.
All right. Thank you so much, Sunny and Rajat, for joining us today. And all right, we're starting not with fireworks on the market at least, but nothing too negative. And sometimes no news is also good news as far as investments are concerned. Definitely completely flat on most indices. But we have an exciting conversation with Nilesh Shah, Managing Director at Kotak Mahindra AMC. Always a pleasure to speak with you, sir, and great to have you on the show today. Especially at a time when viewers, the market, I think anyone who's interested in equities and investments the world over is wondering what is going to happen at this 2-day FOMC meet. So let's start with your perspective on whether this is going to be that kind of a moment when you shift to a regime where interest rates start going lower. What does that mean for India?
So one, FOMC moving on interest rate is well discounted by the market. Till 1 week back, it was 25 basis point rate cut. Now it is 50 basis point rate cut. Now Fed will have to do double communication in Ellen Greenspun style. To equity market, they'll have to convince that we are cutting interest rate because inflation has come down. And to debt market, they'll have to convince that we are cutting interest rate because growth is slowing down and there is a need to boost the economy. If Fed can pass two different messages to markets, then I believe they would have done a great job. From India's point of view, as cost of capital starts coming down in US and as US dollar starts weakening, there is a reasonably good chance that capital will start flowing out of US into emerging market. A lot of money comes now on passive basis, and India is the highest weightage in MSCI emerging market indices. So the FOMC cutting rates resulting into weakening of dollar, resulting into lower yield expectation, increasing more capital flows to emerging market, Indian market should be beneficial.
Nilesh, well, rate cut, of course, almost a given at this stage. What does this mean for India? There is some talk about the carry trade now, dollar rupee becoming the favored carry trade on expectation that the RBI may not move too quickly on a rate cut. Do you feel like Indian paper still is attractive and may be a preferred bet as compared to Indian equity at the current juncture?
It all depends upon your time horizon. If you are coming with 3-month view, undoubtedly Indian debt is more attractive than Indian equity. If you are coming with 10-year view, undoubtedly Indian equity is more attractive than Indian debt. I don't think so. Any investor can expect a red carpet entry in market. There will be always opportunity once in a while, like COVID-20 lows. But other than that, you'll have to enter the market. And it all depends upon your time horizon. Your time in the market will make money for you, not timing the market.
Nilesh, I want to get into a little more multi-asset talk before we spend some time discussing only equities with you. Gold has been the real star when you talk about assets across the board, be it equity, debt, commodities as whole as well. Do you think it could give over 20% returns in 2025? So even at current levels, gold is a good asset allocation bet?
So if we look at gold's return since March 20, that's driven by central bank buying. And central banks are now becoming like Indian housewife, regularly buying gold and not at all selling. It is their buying which has pulled gold prices higher. The second thing which we have seen in history, whenever US interest rate comes down, gold prices move into next orbit. Now, central bank buying is likely to continue as people diversify away from securities, especially of Western bloc. And also US interest rates are expected to come down. This should support gold prices. Some of these factors are already reflected at current $2,600 gold prices. But overall, the bull run in gold prices should continue. Now, will it go up 5%, 10%, 20%? We are not the best person to opine on the same.
Okay. Nilesh bhai, good morning. Niraj here. Just trying to gauge what's your sense of whether the template that unfolds could be similar to 2000 or 2008, wherein there was a correction because of a Fed rate cut or a recession or a combination of both, or could it be closer to 2019, wherein the markets didn't have too much of a reaction, and albeit the valuations were a lot more better there than what they are right now?
So Niraj bhai, is Fed going to say that economy is hard landing and hence I need to cut rates ahead of November election? I doubt if they have so much of political independence. So at least from here till November, I don't foresee Fed saying that we need to cut rates because of high deficit, because of slowing economy. They are more likely to say that inflation is now well under control and we want to be taking preventive action and so on and so forth. Thereafter, let's see how the number comes and what Fed communicates. From our market point of view, we have both kinds of market. There are stocks, especially in large cap, larger mid cap, where business fundamentals are good. Valuations are fairly valued or a little bit above fair valued historical averages. And then there are stocks where experience has become liability. Those stocks are running because of concentrated holding, low floating stock, fancy, whatever you call it. In those kind of stocks, whenever supply emerges, there will be correction. If supply emerges tomorrow, there will be correction tomorrow. If supply emerges 5 years down the line, there will be correction maybe 5 years down the line. So we will see stock-specific movement. I think, Niraj bhai, this is the time where you slowly, calibrately switch from momentum to quality. And the definition of momentum and quality, each one has to make for themselves. You have to move from low floating stock concentrated holdings to high floating stock and market discovered prices. And you have to move from expensive valuation to reasonable valuation.
Fair point. Okay. The other small follow-up is the quantum of cash that domestic mutual funds are sitting on, plus the SIP money that continues every month. Could corrections this time around, if indeed the same template were to play out, be different and shallower than what's happened in the past? Because that's the most often used tape these days, that look at what's happened in the last 4 years, and therefore corrections, if any, will be shallow. Do you subscribe or do you espouse the same theory, Nilesh Bhai?
So let me turn the question in a lighter way. Niraj Bhai, I'm sure you would have seen a Lagan movie where local team defeated English team. We are seeing Lagan playing out in our market every day. First, we saw one day international during COVID time where April, May, June, July, August 20, foreigners came and dumped about 70,000-80,000 crore. They just wanted to exit, so there was no price limit. And retail investor kept on supporting mutual fund via SIP. And we kept on buying. And finally, foreigners conceded defeat. Then they realized that one day international is not where we can win. So they came to play test match. Between October 21 to June 22, they sold about 250,000 crore worth of equity. Again, retail investor kept on supporting us. Don't worry, we are sending our SIP money. Just keep on investing in India growth story. Eventually, foreigners tired out and then they withdrew from test match. Then they realized that we can't win against retail investors and mutual funds in one day or in test match. So let's come and play T20. So on the election result day, they came to play T20, and one single day they sold more than 20,000 crore. Now this time retail investors said, mutual funds, you move out, we'll give you some money, you can do what you want, but let us play directly. They pumped more than 20,000 crore in a single day to take out all the foreigners selling. Now with this kind of domestic participation, you can very well guess what kind of corrections will come and how swift it will be. The point is, in this market, we do expect limited downside for quality stocks, for high floating stock counters, and for reasonably valued stocks. The wall of money cannot stop overvaluation to get corrected. We have seen that in 90s, we have seen that in 2000s, we have seen that in 2008. Money alone cannot support stock prices for long. At the end of the day, stocks are slave of earning power. So my feeling is that the correction for the broader market will be limited, will be shallow, but there are stocks where corrections will be painful, as in when supply emerges.
Just wondering, Nilesh, you talked about valuations a couple of times and mentioned how we have to look at stocks which have not hit their peak valuations. I'm wondering, for you, has your definition of what is overvalued changed in a market that has ignored valuations for some time now? Are you re-looking at the way you see valuations?
So Tamanna, at 50 plus year of age, I am not going to change myself. As I mentioned earlier, this is the market where experiences become liability. But I'll rather retire than change what I think is unfair. We have seen cycles. In the 91 cycle, I ended up losing all the money because I had no experience. In 2000, we could separate us out. In 2008, we could separate us out. So we know there will be periods where exuberance, irrationality can result into momentum stock outperforming you. It's far better to underperform in those markets and tell your investors, tell your distributors that this is our philosophy, this is what we are doing. And I'm not generating performance by chasing momentum. Now,
that right now? Are you seeing that right now, exuberance and irrationality?
Undoubtedly, in some parts of the market, there is irrationality. Low floating stock is resulting into valuation of banks trading at FMCG company, capital goods trading at crazy valuations, real estate and construction companies also showing that kind of sign. So there are pockets, especially in micro caps, mini caps, small caps, and some of these sectors where markets are discounting too much optimism. Maybe one or two out of that will be able to deliver, but not all. And then there are pockets in IT, in FMCG, in pharma, in chemical, in banking, where valuations are reasonable. They may not start outperforming market from tomorrow onwards or today onwards, but over a period of time, stocks are slaves of earning power.
Right. Nilesh, are you bullish on the entire BFSI space, or are you selective in this segment? Banking sector, of course, continues to see challenges on account of deposit mobilization, but if we do get a rate cut, that could be positive. The NBFC sector, capital market related segment also looks pretty good. Of course, valuations have soared recently. How would you play this whole pack?
So within banking today, we have to wait and watch how liquidity coverage ratio guideline comes. Those guidelines could have potential adverse impact on the NIM of the bank. The second thing will be obviously deposit and credit growth. Today they are in low double digit. Can it move to slightly higher level? And third thing is valuation. Undoubtedly, valuations are now trading below historical averages. So we are overall bullish on banking system on a selective bottom-up basis, but we'll wait for liquidity coverage guidelines impact to come through and then start accumulating furthermore.
Also, I want to talk to you about a product in some sense, right? So from more of an investment angle, we saw a beautiful rally over the last 1 year on some of these PSU stocks and hence on PSU mutual funds. Investors who invested in these funds have made phenomenal or created phenomenal wealth. But as we stand at a juncture where the PSU house is split between some that have ran up significantly, like those defense and railway counters, to some like energy stocks that still show value, what would be the advice to investors who hold these PSU mutual funds? Right time to exit, right time to invest, or just do nothing?
So my recommendation will be, if you are in passive funds, then look at the composition. If the composition is tilted towards low floating stock counters, highly overvalued, then it is time to book profit. Don't do it today itself. Do it in a calibrated manner, because unless until supply emerges, these counters are not going to fall. Emergence of supply, increase in floating stock is absolutely important for these stocks to come back to their fair value. On the other hand, if you are in those PSUs where valuations are still reasonable, there is reasonable floating stock to determine that price, then you could stay invested. If you are in active PSU, then let the fund managers take a call as to when they are going to make a switch, as to how they are going to position portfolio in terms of market expectations. So active PSU funds continue, passive PSU fund, look at the portfolio and make a calibrated switch.
I'm wondering, how are you feeling about the primary market right now? The primary market, I think, is the most action that we're seeing, and there's been a blockbuster listing yesterday. Bajaj Housing Finance is the talk of the town. Let's start with your views, Mr. Shah, first on Bajaj Housing Finance and then all the buzz that you're seeing in the primary market.
So we can't give stock-specific comment, but in the primary market, undoubtedly supply is coming, and a lot of those supply is getting absorbed by the retail and institutional investors. There was a time when once for selling an issue, you had to travel to Singapore, Hong Kong, London, New York. Today, you can sell that issue in Bandra Kurla complex or Lower Parel at best. So there is an emergence of domestic retail and institutional investors which can carry out the IPO. This primary market supply is increasing undoubtedly as valuations have become attractive. And going forward, I think at this valuations, one will have to be careful while investing in primary market IPOs. Many of these primary market companies are getting listed at a substantial premium to existing listed players. Over a period of time, that will get corrected. So be careful as to what you are investing into. Don't apply based on grey market premium. That's not reliable. And do keep in mind valuations, because it's not that every primary issue is going to get listed at premium to their issue price. price is what you pay and value is what you get. And one final thing which I look forward to primary market, by and large, top of the market is made by a large issue, which is very, very expensive. We saw that in 2008. We saw that in 2017-18. So I'll be looking forward to primary market, hopefully, where history repeats itself. And there will be one large issue which will be very, very expensive. And that hopefully will make the top of the market.
Okay. Nilesh bhai, one final question from my end. The other common tape is that large caps, because of the valuations, are best placed right now or better placed right now, and mid caps, small caps are not. But a lot of emerging themes are not necessarily large cap themes. They are not present in the top 100. So would it be wrong to shun the broader end of the spectrum, or do you reckon that if there is a mid cap, small cap correction, then even the good stories will fall, take a very sharp hit?
So Niraj bhai, there's no general statement that large caps are cheap and small and mid caps are expensive. At the end of the day, it is all bottom-up story. If large caps are not growing, then even this valuation may not sustain. And if small and mid caps are growing at a faster pace, undoubtedly this valuations can sustain. So it is more of a bottom-up stock picking. Try to factor in what market is pricing in at current valuation. If it's pricing in 100 P, that means we are discounting 2,124. Now, will the company be able to grow so fast that maybe we are just discounting 2,034 and not 2,124? That's the call. Any company which is going to deliver below what is expected by the market is unlikely to deliver return. So between large, mid and small, try to go for companies which have leadership in their industry, which is able to withstand technological disruption which is coming, and where the business fundamentals and financial valuations are reasonable. Today we are seeing many companies' prices have run up simply because there is limited floating stock. There are companies where prices have run up simply because people are pricing in unrealistic expectation, in our opinion. So try to figure out what market is pricing and then build your portfolio around it.
Thank you, Nilesh. Thank you. It's always so good to have you in the studios, and of course, even more important when most people believe that we are in a secular bull run, and valuations, of course, though, continue to remain a concern. Well, let's move on to one company that's been on an acquisition spree. They've been on a massive buyout spree with the latest acquisition of Moonshine Technology, which runs skill-based real money gaming platform PokerBaazi, SportsBaazi and CardBaazi. In the last 6 months, Nazara Tech has spent 1,800 crores on M&A to expand its market footprint and strengthen technological capabilities. Nitish Mitra Sen, Joint Managing Director and CEO at Nazara Technologies, joins in. Hi Nitish, good morning. What's going on? 1,800 crores spent in the last 6 months on very, lots of acquisitions. The last one being the biggest. You want to tell us what's the thinking, what's the rationale, what do you plan to achieve? You're looking to invest 982 crores in Moonshine Technology.
Sure. As you know, last year, Nazara raised significant primary capital, and our whole objective was to deploy this capital for, well thought out mergers and acquisitions, something that we've been very successful in the last few years. Last year, my team has worked on a very, strong deal pipeline. We focused on opportunities that fit our framework. We've been very patient about it. And what we're seeing now is really, I would say, an outcome or action basis all the work we've done in the last year. We do believe that Nazara is very well poised to, capture opportunities in India and globally, and is emerging very fast as a global gaming platform, the first global gaming platform out of India. This is a dream we started the company with, and this is very much we continue to pursue.
Nitish, help me understand this, because this is an industry that does get impacted by regulation and has been. The real money gaming space in India, while rather significant in size, let's not forget that in the last few months, it's grappled with severe tax burdens, funding issues, and layoffs. And the government has levied a 28% GST on a player's deposit. Do you not feel like these are worries and, of course, reasons why the sector is not growing as much as it you'd like? Or are you looking beyond this and you feel like these are teething problems and the sector and this acquisition could actually help Nazara grow significantly?
We have been very patiently been sitting on the sidelines in the skill-based online gaming space over the last few years, especially with, especially since our IPO, you had a situation where every quarter we were asked about our exposure to that business, and we always said that we are waiting for clarity to emerge. I believe at least some positive steps were taken when there was more clarity in terms of taxation on this industry. While the industry may have not particularly liked what the outcome was, at least clarity emerged. And I think from a Nazara perspective, as a responsible listed company, investing into businesses where there is clear picture of how this business can pan out going forward was important for us. We do believe there's a lot of scale that is possible through this business, and we hope to support it with our 48% stake going forward.
Hi, Nitish. Morning. This is Tamanna here. So you have a board meet to consider a fundraise this week. Are there more acquisitions on the horizon? Just understanding strategically. And I know maybe you can't give me details of the fundraise now since the board meet is tomorrow, but what is the thought? Is this more inorganic expansion that you want to fund?
Yes. So obviously we made a large commitment on the PokerBaazi deal that we just announced, and we thought it was appropriate to raise some additional capital. We have a board meeting scheduled tomorrow, which is Wednesday, so we'll have more information out soon.
To raise, and you have a significant amount of cash on your book as well. So is the PokerBaazi, is the moonshine acquisition coming out of this fundraise? Just give us a sense there.
Yes, I mean, money is fungible, but that could be one way to look at it.
Okay. Just on the point you made about regulatory hassles with PokerBaazi, SportsBaazi, that entire suite, what would be the GST impact there? Now, have you budgeted for it? How are you dealing with that kind of headwind? Because clearly, online gaming is never going to be seen with a very benevolent eye by regulators, by the government. How do you bake that into a business model?
I think it's an evolving industry. And as in any new technology, any new evolving industry, there will be regulatory changes, and the business needs to be, geared to absorb any such changes. I'm sure the government will do what is appropriate, and we are supportive of it. As you know, in the recent GST Council meeting, they brought out that GST collection has increased significantly, almost 7,000 crores in the last 6 months from online gaming. And therefore, I'm sure the government will take appropriate steps to bring clarity, to regulate the market. And I think for a company like Nazara to get involved, to provide responsible gaming, with the first priority being consumer protection, I think companies like ourselves can, really bring that to the table, which many other players may not be able to.
Just to understand, Nitish, all of the platforms on Moonshine, they attract 28% GST right now?
Yes, it's 28% GST on the money that is deposited.
And have you seen that really hit demand over the last few years?
No, I mean, this new GST structure came in October of 23, and the platform they've adjusted. Of course, it's been painful for them. Profitability has definitely got eroded because the cost of GST has gone up by 400% for online gaming platforms. But like I'm saying, I think it's an evolving situation, and we're hopeful that the sweet spot on that will be found between the industry, government, and other stakeholders.
Nitish, good morning. Niraj here. I'm just trying to understand, when new money that is coming in right now, what's the growth that they are seeking? Because you're obviously telling them your foresight into how Nazara will do over the course of the next 3 years, which is why they'll put in the money, whether they put in tomorrow or some funds that you may have tied up, so on and so forth. What is the growth prospect, and where is this growth largely coming from? The new moves that you're making, the existing businesses growing at a faster clip. How is that whole landscape?
Sure. Of course, we haven't shared any specific guidance with investors beyond what is already publicly out there. Our public guidance for FY27 is, INR 300 crores of EBITDA, up from FY24 EBITDA of 129 crores. But I think we do expect that we will pick up pace on the organic growth of our businesses. Some of our businesses, especially our esports business, our core gaming business, we see a lot of prospects. Nodwin Gaming continues to be the market leader. Sportskeeda has globally become a sports destination to contend with. So I think there are a lot of opportunities for our organic growth. We also have fantastic momentum when it comes to inorganic growth, and it's also a great opportunity because globally, today we are able to acquire the right businesses at the right value. So I think it's a time in the moment where we can really take advantage of these opportunities, and which is why we are accelerating, what we are doing today.
Nitish, this public guidance that you've given is 3x over 3 years, right? From 100 to 300 from FY24 to 27. Now, I'm sure high growth area, yes, but it is a strong guidance nevertheless. Are there or what could be the reasons which might cause you to miss this, if at all? And is there a possibility of you bettering this? I mean, what I'm trying to gauge is that, is this conservative, is this base case, or is this aggressive, the guidance of EBITDA of 300 crores by FY27?
I would call it realistic. We will always, as a company, endeavor to, beat our guidance and do better, of course. And of course, it's a dynamic business with constant technology change, consumer preference change, as you just mentioned, regulatory changes. So there can be many reasons, that come in the way as well. But our effort, complete positive intent and positive effort, is to achieve our guidance and beat it.
Okay. And Nitish, what's the nature of money that you're seeking? I mean, I'm sure there are a lot of people vying to get into this fundraise exercise that you're doing. Are you looking for global funds, strategics? Are you looking for domestic investors? What's the color of money you're seeking?
So we have significant interest from our existing key investors, and obviously we will, prioritize for some of them. But beyond that, I think it should be a, good list of incoming investors who can support us for the long term.
Nitish, one quick question. You had one acquisition that you made in August of Fusebox Games. You had a stake purchase in Paperboat in July. These are, of course, the last two, just ahead of the one you announced this week. They're quite large. Are they already revenue and profitability accretive? If not, when do you see full integration and full impact of these recent acquisitions to your top line? Would it be next quarter? Would it be the quarter after? And could you quantify that for me?
Sure. In the case of Paperboat Apps, which owns the popular kids app Kidopia, we already own 51% stake in the company, which we increased to 100% and made it a wholly owned subsidiary. As far as Fusebox is concerned, it's a fast-growing studio in the UK, which we really liked. It's already profitable, around a run rate of around 50 crores annualized EBITDA. And generally, we are acquiring studios or businesses that are profitable, EBITDA positive, and also cash flow positive. That's really one of our, key filters in our framework that we like to purchase. We're also getting them at attractive valuations. As you saw, Fusebox, we paid around 230 crores. So I think it's extremely value accretive for Nazara shareholders.
Anything else on the radar that you're in conversation with? You can answer that with a yes or no. I don't know. There'll be limitations.
We're always in conversations with many companies.
Okay, so I guess an announcement every month is what they've done so far. Maybe one more could be lined up in the month of October. But thank you, Nitish. Good luck with business. It's been a good run. 1,800 odd crores of acquisitions in the last 6 months, sitting on a pretty solid chest of cash, but they have a fundraising meeting lined up. It's not just this one, but a whole host of other companies. Money is fungible, so maybe there is a new announcement on the radar.
Yeah, seems like it. Seems like it because, like he said, he's always in conversation. But I mean, raising money is what you do in this market right now, isn't it? Look at the pre-open sort of rates settling for PN Gadgil Jewellers. And it's a company that you've been tracking, Samina, and you spoke to them as well. Live pictures right now, just ahead of the listing ceremony, which will be in just about 3 minutes or so. That's another bumper listing, second day in a row. PN Gadgil is no Bajaj Housing Finance. It's a relatively smaller company. It's a Pune-based jeweler, and it's seeming like it will have a shining debut.
I think one thing both Bajaj Housing Finance and PNG have in common is they're both Pune-based. So I think that's the common thread between the two entities who've got Bajaj Housing Finance. We've seen PNG is expected.
You guys saw the meme yesterday? There's a meme which said that there are 3 circles, 3 concentric circles.
Oh yes, I saw
Investors
that.
who got Bajaj Housing IPO allotment, PNG IPO, and Diljit Dosanjh tickets. God's favorite child.
Well, this is a big one that we'll be tracking. 1,100 crores is what they were looking to raise through this IPO, which was well subscribed. What was interesting is there weren't too many international institutions that came into the anchor book for PNG, but a lot of the local domestic institutions have subscribed to PNG through their anchor book. Couple of things that stand out is the grey market was indicating to a 65% upside on listing. So more or less on expected lines in today's trade. But what has been in some ways lucky is that PNG is listing at a time when gold prices are also trading at a record high. So that's a huge positive coinciding with
really
PNG.
Because wouldn't that reduce appetite for going out and buying gold jewelry?
I think people would want to buy more, right? Because if the outlook is positive, and if you're a stock investor, the other companies that you're looking at are already looking expensive. So if you're seeking value, this one's not actually too expensive. It's largely in line. Of course, your Kalyan Jewelers and Titan are some of the outliers, but keeping in mind that PNG is in line in terms of valuation with Senco, for example. But business focus largely in Maharashtra. 60% of their revenue comes from Pune city alone. They have owned 17% of India's jewelry business in the organized space. They are looking to venture into diamonds as well. Money that they're raising will be used to add 12 new stores, so expansion plans are aggressive. Margins are looking healthy. They also operate an asset-light franchise model, which means that they can grow a lot more in smaller cities like Tier 2 and Tier 3 through the franchise model. All in all, it's looking good. The management is very excited. They've been in the business for many decades together, and this seems to be a culmination of all that effort that the Gadgil family has put together, Tamanna and Niraj.
Yeah. I mean, that's the thing about listings, right? They're really happy family affair as well. But it's a roll of the dice, really. What kind of a listing you have for PN Gadgil definitely seems positive, and in a space where there is a lot of excitement right now. The whole jewelry and consumption space, especially discretionary consumption space ahead of festive season. You have one more player added to the pack with the likes of others.
9. Heartfelt congratulations, ladies and gentlemen. PN Gadgil Jewellers Limited.
That is the Big Bang listing, largely in line with what the street was expecting. A 70% gap up, 480 rupees was.
Better than I
65 is what the street was betting on. It's adjusting to that from the look of it. So 800 odd, 810, but this is phenomenal. I don't think the management would be disappointed. It's a strong listing. It's a strong player. Valuations were compelling. From most companies tracking the IPO market had a subscribe on this one. 811 is what we have on PN Gadgil, which is a Maharashtra-based jewelry company.
Yeah, good showing. The question is, can they do more going ahead as we hit the peak of the wedding season, and of course in the run-up to the festive season as well. Remember, gold buying will hit a frenzy sometime in the next couple of months. So that's to be kept in mind as well. But good listing. and the spate of good listings continue. Just before we wrap up, just want to mark Bajaj Housing Finance yet again was up about 8-9% on open, at around open, and I wonder if that has held through as we speak as well. So that's the other one, which is about 6.5. But PN Gadgil doing well, Bajaj Housing Finance doing well. Can't say the same for the other two which got listed yesterday, but listings by and large have been okay. Okay, what we do is wrap it up on this leg of India Markets Open. Thanks so much for tuning in. Up next is Talking Point. Thanks for tuning in to Talking Point. I'm your host, Niraj Shah. Bit of a corrective mood at the broader end of the spectrum today. About 0.4% lower for the small cap space. A lot of stocks are correcting. And correcting, well, not with deep cuts, but reasonably. Godfrey Phillips has become a big trading stock, down about 6%. But Apar, KRBL, Triveni Turbine, Linde India are some of the others which are looking slightly wobbly in the session today. Volumes acceptable on some of those. So, yes, the corrective moves are there. On the gaining side, IGL, MGL, the two twins have done really well, 4% apiece. On the UBS note, there is strength in PB Fintech at 1858. I reckon this is trading close to life highs, so doing okay. Maharashtra Scooters continues to rise and shine, so yet another 2.5% gain given in for this one. But I must say, Chola Holding, Mass Financial, a clutch of NBFCs are doing okay too. So that's the other thing. And Nuvoco Vistas has piled on some gains today, 6.5% higher for that one. So that's the word on some of the stocks on the BSE 500. The new kids should come up on your screen, the new listings. That's the big story, right? So look at PN Gadgil Jewelers. Today, the debut 67% higher. Bajaj Housing Finance should come up on your screen. Cross could show up on your screen as well. Tollin Tires down 5%, Cross down 3.5%, Bajaj Housing 7.5%. But like I said, amongst the best performing stocks today are IGL and MGL, and I would reckon the whole credit goes to the analyst of UBS who wrote the note upgrading or upping the target prices, I presume, on both of these. Mihika, my colleague, has the details of this note. Mihika, good morning. What does UBS have to say?
Good morning. They're actually very positive on IGL and MGL both. What they've done is they've upgraded IGL from a sell rating to a buy rating, and they've raised the target price at a new target price of 700 rupees, and they've reiterated their buy on Mahanagar Gas at a new target price of 2,400. Now they've noted the consolidation trend in the city gas distribution segment, and they said that, and they expect this trend to continue. They've said that the pressure to meet infrastructure targets, challenges of gas sourcing, as well as opportunities from the regional overlap could be the drivers of the consolidation trend. Now they've said that large city gas entities such as IGL and MGL which have a net cash balance sheets have stated their intention in participating in this trend, and the inorganic growth prospects and the strong near-term fundamentals should support the re-rating going forward as well.
Okay. Mihika, are there any risk factors that are alluding, or they believe the valuations are very compelling?
No, so when they've spoken about risk factors, like I think it's key to note IGL, because IGL's majority of its gas volumes are under the EV threat because of the Delhi EV policy. So that's one of the threats that is underlying to the IGL. And overall also, if you see the CNG conversion rates, well, they were healthy for the month of August. So that's a driver for the companies as well.
Got it. Thanks, Mika. Thanks for that. Well, the case for a chat for our guest on Talking Point, Ravi Dharamshi, today, we asked him whether the concept of value has changed. He's tweeted extensively about this. Would love to know his thoughts there. Also try and talk about whether some of the high price themes are now baking in all the positives, particularly power or defense, but power in particular. Has the potential been priced in? And he was also amongst the earlier identifiers of the EMS theme. That theme seems to be having a non-stop run. Look at almost every business, and they are bagging in more clients and doing well. In fact, companies talking about how India can become an EMS hub. We asked Ravi, how does he think of it? He and his partner have also written a book, and we'll try and talk to Ravi about the book as well. Ravi, there's so much to talk to in the next 20 minutes. I don't know if we'll be able to do all of that, but thank you so much for taking the time out.
Thanks, Niraj. Thanks for inviting me.
The pleasure is entirely ours. Ravi, let me start off by asking you about this set of tweets that you have put out on the platform X, wherein you're talking about whether the concept of value has indeed changed. And I think you ascribe to that theory. In fact, you espouse that theory. Tell us a bit about it.
So, see, I don't think the concept of value has changed. But what happens is, as the markets have evolved, everybody tries to bucket themselves and I'm a value investor, I'm a growth investor. And I think that is what creates confusion. Every type of investing is value investing. And that is what Warren and Charlie have said over a period of time. And I had tweeted a particular video of Warren speaking about it also. And I think value and growth both are not a mutually exclusive concept. Growth is very much a part of the value equation. If you want to estimate the value of a company, you have to know what the future growth is going to be. There are certain people who completely shun away from doing any kind of a forecast and say, I will buy when the intrinsic value of the company is much higher than what the current quote of that company is. Now, I'm not saying that it is absolutely a wonderful thing, but those kind of cigar butt investing opportunities come very, very rarely, like once in 2 decades maybe, where there is a crisis of sorts where asset prices fall so much that they become very, very attractive in relation to their own intrinsic value. But in a regular, course of business, and especially in a market like India, which is a growth market, you will be hard pressed to find opportunities which fit into this particular traditional definition of value. So the value of an asset in simple terms, if you take the formula, is the discounting of all future cash flows. By definition, it is all future cash flows. So you have to know what the future cash flows are going to be. Now, if you figure out that the future cash flows are going to be much higher than what they are at present, because there are certain aspects about business which are panning out now, then you will suddenly realize that there is very apparent value, even though in the traditional PE format, it might not fit. And that is what I have been trying to dispel, that myth that just because on a TTM PE basis or the last year PE basis, a stock looks expensive does not mean it is actually expensive. There is a fine logic why there is a lot of value in it.
Ravi, the help our viewers understand the constant pushback to something like this is that, we've seen this tape play a number of times in the past. It looks good till it is looking good, then it tends to correct, and stocks which priced at X valuation at some point of time will come back. And then the last 4 years have shown that expensive stocks continue to do well. I'm not asking you to comment on a Dixon, but I'm using that as an example, right? For a brief period notwithstanding, it's always stayed an expensive stock, continues to do well. There is a Keynes Tech which has continued to do well. There are a clutch of others, power companies or wind equipment companies, continuing to do that for the last couple of years. So how does one wrap her or his head around what can be construed as expensive and what is not too expensive, because there is growth and therefore the value is in the growth of the company? How does one distinguish between the two?
No, I think there's a very simple way. Of course, it entails that you do some scenario analysis on what's going to pan out in the 10-20 year time frame. Often enough, even in the bottom of, right after 9/11, when the stock prices were dirt cheap at that point of time in September 2001, you would have found that in Asian Paints was still expensive vis-a-vis the market. A Titan was still expensive vis-a-vis the market. Now, at that point of time, you could have said that, these are expensive, let me buy a 5 PE multiple company. Yeah, sure, you would have bought 5 PE multiple company and made some money on it, not denying that. But you completely missed the point if you just focused on valuation or historical valuation. What about understanding the business? What about understanding the management? What about understanding the prospects of the business 5, 10, 20 years out? And if you would have understood that, then you would have realized that those seemingly expensive stocks were actually the cheaper ones. And the seemingly cheap stocks were actually the expensive ones, because you lost out on an opportunity. You did not understand the prospect of that business. So if you can say that, and I'll take that example of Titan again. Now, it's not like everybody has a clear picture of what's going to happen. But if you could foresee that there's a large, jewelry market out there, Tata's has a trusted brand name, and there is a management in place that is focused on creating that value, then it would have become very, very clear that it's okay if the traditional metric of PE and price to book might say that this is an expensive stock. But this is a long runway. There is a lot of predictability to it. And you can say that the probability of a Titan becoming much bigger company was much higher than, let's say, some XYZ company becoming that large. So focus on identifying that predictable growth over a long period of time, and where markets are actually probably underestimating the kind of growth that can happen. That is where the value lies. I mean, I hope I've been able to explain, but honestly, I'm not very good at articulating as maybe some of the other valuation experts are.
No, but you're undermining yourself, Ravi. I think this was a very good explanation and much needed as well. So let me try and correlate this, Ravi, to the current pockets, one or two that I have picked out for a conversation today before we talk about your book as well, because that's the third one. But the first one, EMS, because you were amongst the earliest identifiers. Now, the stocks have done have had a long run. I mean, I was looking at the Dixon market cap today, 85,000 crores. That's something that's gotten created in the last 4 years. But we have some charts here, and which shows, one, that the government targets for electronics, finished goods production and components production with policy support. Base case, some people say, Niti Aayog Research and Nomura Research suggests that FY30 base case Look at their growth from 86 to 253, and with policy support from 86 to 350, that's nearly a 5x jump in finished goods production and a 10x jump in components production. And viewers, the other piece that one of the research notes suggests as well is the electronics production as a percentage of GDP will shoot up from circa 3.8 currently to maybe 5.3 by the end of FY27. Ravi, are these stocks which are optically expensive and may look cheap as earnings growth comes in, or are they actually expensive?
So, see, today, no doubt about it, they are factoring in a lot of the future. So there is a risk to the extent that what if the future is different than what the stock prices are suggesting. However, I'll just give you a framework on how we think about it and how we attach probabilities to the outcome. And that might give you some sense on how to evaluate this. So 2-3 years back, when this sector was actually getting born, or where new companies were getting listed, at that point of time, this valuation concern was actually totally not required. Why? Because, see, we tend to track a lot of these trends on a 10-20 year horizon, but only when they cross a particular inflection point that we bring it on our radar or make it into part of our investable universe, is that the growth is going to pan out in the next 5-7 years and not in some 10-20 year horizon, which might not be my investment horizon to begin with. So when government in 2014-15 started talking about Make in India, and then they came out with a policy for electronic manufacturing, we knew that this is the beginning of a particular mega trend. However, we waited until Samsung came here, Apple came here. Once the OEM started coming here, and of course we all start with low-end assembly work, and then the ecosystem around it started developing. That's when you keep your eyes out for companies where there is some differentiation, where they are showing some signs. Who are these large OEMs beginning to work with? Those are the companies that you should be focused on. And then you have a reference point, how this particular thing has panned out, whether in China, whether in Taiwan, and someday we will have our own Pegatron, Winstron, Foxconn out of India. Yes, there is all possibility and likelihood that we will have, because government has created that required ecosystem and the required ingredients from where the entrepreneurs can actually start charting their own path. So that is what tells you that give or take a couple of years, this story is going to pan out. And in that kind of a scenario, you don't try to value those company on what the current year's earnings multiple is, but you try and build scenarios, what kind of size this company can become, what kind of profits this company can make in a 3-5 year horizon, and then see vis-a-vis that scenario, is the stock still very attractively valued or very cheaply valued. And in that also, you don't have to make extravagant predictions or forecasts to justify your position. Even in a base case scenario, if it is attractive enough, then you can let the upside you surprise yourself. That's how we think about these things.
Well, maybe that's how money is being made these days as well, Ravi. So thank you so much for that example. Wonder if the same analogy applies to power again. I could mirror those charts, Ravi. Remove EMS, put in power, change the words, and the bar charts would look the same in terms of targets, etc., right? And the stocks have also run up. But it's a different sector, per se. How do you think about this space?
So when you say power, I'm assuming you're talking about power equipment companies. Or are you talking about power
equipment generation. Okay, let's stick with equipment. Let's start with that.
Yeah, so again, the same thing. What is the size of the opportunity? How soon will this opportunity pan out? See, people talk, we don't like to talk in terms of 10-20 years. We like to talk in terms of 5-7 years. And is that opportunity going to pan out in that 5-7 years? Basically, will the government be forced to spend money on building power transmission infrastructure, or even private sector will have to spend that money? If you see today, for example, for all the renewable generation that is coming up, the single biggest factor that is impeding that growth is the connectivity to the grid. So basically, you need to put those transmission lines in place today if you want the entire energy transition to succeed. Otherwise, we would have failed. It's like paving the roads before selling cars. You cannot sell cars if there are no roads available to drive. So first you have to pave the road. So power equipment companies are essentially catering to that opportunity of paving the roads for energy transition, and that spend needs to happen in the next 5, 7, 10 years. And because of that, and the delta is huge in terms of spend. If X was being spent 2 years back, in the annual number for that X will become 3 to 5X in the next 5-year horizon. That's a huge delta. And then there are very few companies who are catering to that kind of an opportunity. So there is a huge delta in terms of opportunity, and now there is a right to win of certain companies, which is why the stock prices are running probably slightly ahead of even ordering. We saw the same thing in defense as well. Way before the orders started coming, the stock prices started moving. And with every order, the stock prices have been going up. So this is how usually a cycle plays out. Now, of course, probably I can say defense has reached a point where ordering has kind of reached a kind of a peak level, and now you are carrying the entire execution risk ahead of yourself. Now, that not to say the opportunity won't pan out, but now the risk reward might not be that favorable from the next 5 years perspective.
Got it. Okay. But point well noted. We have time for one more question, so I'm gonna now extend the power thing to a green revolution giga trend. And I believe that's the book, Ravi, that you and your partner Varun have written. I was lucky to get a copy of that book, Ravi. I would love to understand in brief. We'll probably do a separate show on this, but today, for a brief, in the next 3 minutes odd, can you tell us a bit about what is the message that you're trying to convey from an investor's perspective? Anybody who's an investor and listening to you right now, trying to think about this theme and trying to get an excerpt of what you're trying to say, what would you mention?
Yeah, no, thanks for that question, Niraj. So first of all, the way we look at this is that energy transition is not new. Okay, we've been moving from various forms of energy. There was a point in time where coal was a big percentage, then oil took over, and now oil is being replaced by renewable. But what is different about this particular energy transition is it is being driven not by natural resources which are to be dug up from the ground, but it is being driven by technology which is made in factories. So there is a learning curve involved over here. These technologies tend to keep improving. As you produce more and more of it at a scale, they become cheaper, they become more efficient, and they are able to extract more. So that is the main difference between this particular energy transition as against the previous one. Another thing that's different about this particular energy transition is that there is a time-bound nature to it. It's not like it will take its own due course. We have to achieve a certain level of carbon emissions, and to achieve that, to reduce that carbon emission, we need to achieve some level of renewable penetration for those carbon emission norms to be achieved. So there is a timeline to it as well, and we always prefer opportunities that come with a timeline, that this has to be done in the next 30 years, this has to happen in the next 10 years. That is when opportunities become real. So that is the point. Now, the backbone of this entire energy transition, in my opinion, is going to be solar. Why solar? Why not nuclear? Is because there are three things that are needed for a particular technology to be adopted at a mass level. Cost, basically, which means affordability, accessibility, and acceptability. So with nuclear, cost is an issue. With nuclear, accessibility is an issue, because people, there is something called as NIMBY effect, not in my backyard. If you were to put up a nuclear plant, let's say 10 kilometers away from Bombay, I don't think the entire city is going to agree to that plant today as of now. So basically, you will have to go to remote location, which might probably increase the cost even further of evacuation and everything. So a technology can become mass only when it is accessible, affordable, and it has reached that mass adoption level. So yeah, so those are the points that we want to make. Now, this energy transition as a theme transcends many sectors. Okay, on the generation side, on the transmission side, on the consumption side, on the new technology side, on the financing side. So from time to time over the 30-year period, some subsectors from the energy transition will end up being a beneficiary. I'll give you an analogy of internet. The entire pipelines for internet were laid in the late 90s, early 2000s. However, the eventual winners of that pipeline laying probably are being discovered today. Google, Apple, Microsoft, AI, those are the beneficiary of the pipelines that were laid 20 years back. So think of this energy transition also as a pipeline exercise that is going on for the renewables. And at some point of time, in 20 years down the line, we will see that new business models have suddenly cropped up which leverage on this particular thing. I'll just give you one example that I can think of right now. Is heavy manufacturing industries where the power cost is very, very high. We are already witnessing that the power costs are falling to zero, or it is actually power is becoming a source of revenue rather than a source of cost. For example, let's say spinning in textile is a very power intensive business. But if you have your own solar plant, you are actually making money. You are supplying power to the grid. And your competitor now has no choice but to actually install a solar plant of its own, because otherwise they will not be able to compete with you at all.
Wow. Ravi, this calls for a longer conversation. We should do a very long format conversation on this, because this is a very interesting thing. Unfortunately, I don't have time today, but I urge you that in the next 15-20 days, we should try and get you to the studios and try and do a very long format conversation on this. But thank you so much for giving us a snapshot of this today.
Thank you. Thank you so much for inviting me.
The pleasure is ours. And viewers, that's all that we have time for on this very informative edition of The Talking Point. Thanks so much for tuning in.